Welcome to this special update from Mint.com Technologies. Today is August 6th, and I'm writing, or actually videoing today, to let you know that I think we are in a very crucial mode in the markets. The easiest way for me to describe it is that I believe we are in a combination of a dot-com bubble, speculative bubble, very similar to the late 1990s, 1998, 99, 2000, on the precipice of entering into a mid-90s crisis cycle that took place during the extended Kuwait War. And I believe what's going on with the saber rattling in China and Russia, we now have a war in Europe that may be protracted, and we may have a battle taking place in Taiwan pretty soon. We need to start rethinking things, ladies and gentlemen, with regards to the long-term cycle phase for oil, for the U.S. dollar, and for really the U.S. stock market. So what I'm doing is I'm creating a couple of charts here to show you what's going on and to highlight. So here's an example of the dot-com bubble burst. Right here. This is 2000, 2001. You can see we had the ramp up in the US dollar in the mid to late 90s, going all the way forward into and through 2001 and into 2002 until the Fed started really pumping money into the economy and we saw a downturn in the economy in the US dollar. This was a weakening cycle phase. We had entered into war at this point. In fact, let me draw a line here to show you that we had entered into war by late 2000, roughly in this area. We had entered into war. I'll change that color to red. We had begun a downward cycle in a depreciationary cycle phase. This red line here, try to make this a little bigger for you. And make this a little bigger, highlights what are called appreciation and depreciation cycle phases. They're roughly a 9.5-year cycle that takes place over and over again. We are currently in a depreciation cycle phase. So again, you can see the dot-com bubble peaked here in 1999, 2000. Here's the stock market down here, 1999, 2000, peaking. This is the SPY. Then we moved into the 9/11 attacks, roughly right there, 9/11, 2001. And so here's the attacks. Let me draw that. There's the terrorist attacks. I'll try to make those kind of a yellowish color. And not but a year later, we entered into war. And that caused a depreciation cycle phase in the US dollar, a very strong appreciation phase in gold. Try to change this into kind of a goldish color. And here's oil. I'll make this black or darker. And I want you to understand that oil at the time, we didn't have clean energy. We didn't have a lot of clean energy. Oil ramped up through the roof. But look at the decline in oil here from the peak before we actually started in supply disruptions with the war in Iraq. So understand that oil at this point in time collapsed down close to 60% in oil. Okay, 55 to 60% in oil. Where we're at over here, if we're executing the same type of a pattern, we could be looking at, let me try to get something over here, 60% decline in oil, we'll put us right about here. That puts us down in the $55 area for oil. Actually a little lower. $49, $50 area for oil. If we get the same type of collapse. Now understand, when the credit crisis happened, we saw oil collapse from these levels down to these levels, 75%. So this raises the second question that I want to talk to you about is, I've already explained how I believe this is very similar to the dot-com bubble burst. Okay, we've got a number of things going on that we just don't see, and it's unlikely that the Fed planned this, although they could have essentially inadvertently set this up. So we not only have the dot-com technology speculative bubble burst taking place right now after COVID, but we also have a potential global financial crisis with the carry trade and the strength of the U.S. dollar. This is something that we're likely going to see something happen, although in the U.S. market, back down here when we had the global financial crisis, the end of a depreciationary cycle phase, it was primarily U.S. based. This time, I believe it's going to happen globally. It's going to become emerging markets issues, and it's going to become an emerging market trend, which again highlights kind of an area back in this area, which was more of an emerging market issue, where emerging markets supported after the global financial crisis. This became a big trend for emerging market strength. And then in 2013-14, we had an emerging market meltdown. Global economies started to collapse a bit in 2015-16, and then we saw it collapse a bit further through COVID. This was the COVID collapse. This is oil. Of course, the U.S. markets continue to stay strong because foreign markets, when this collapsed, when global markets started to really weaken, U.S. money poured into the U.S. Stock market and continued to climb. So if I'm correct and we get another type of a foreign market, emerging market collapse because of war, because of extended debt crisis liabilities, and that money pours into the U.S. stock market, while the U.S. dollar continues to attempt to move higher, we're looking at a very interesting, let me find the drawing tool, scenario to set up. So for example, the SPY could move a little bit lower is my expectations, try to find some support near the mid-COVID area, and potentially then move into what is called an extended phase 4 pattern for a breakdown. And I'll explain that to you here. I'll try to draw some lines. So here's roughly the mid-early COVID area, and in reality, I'm looking at these 2017 peaks back here as a support zone for the U.S. market. Ultimately, we have a different support zone way down here in the 2015 lows, which I'll draw a little darker. That's the ultimate support zone for the downside. So for the U.S. market, we're going to see probably another wave down, which is going to possibly push the U.S. dollar into a bit more of an uptrend, maybe up to 117, 118. And understand that's very similar to what happened back over here, pushing it higher before it rolled over. So we're looking at the same type of setup right over here. With regards to gold, we're pretty much right in this area right now, right in this low area. And understand that gold in this area rallied through the end of the contractionary phase, the depreciatory phase, all the way up to these highs way up here. So we're looking at a massive rally in gold that could be just outstanding. I mean, I don't know how to explain it to you. If gold is doing the same thing and moves from this cycle here upward through the cycle phase, we're looking at a massive move in gold, and this doesn't really carry it forward. This was a 500% rally, and again, from here, a 500% rally would put us up to 10,000. So understand that it's a massive, an absolutely massive number. Let me get rid of this and try to draw it. It would be something more along the lines of that. Just an incredible rally phase in gold. Now, let's go back to where I'm talking about here. So when we look at this, and we start to look at this setup, we start to really combine three things. Number one, a destruction of foreign capital, meaning currency and economic capability. Many foreign nations have piled into debt, thinking easy money was going to be here forever and that we would never see this type of an inflationary trend. The only time that this is something that's familiar to anything that we have going on with regards to inflation right now and the peaking of the U.S. markets and the strength of the U.S. dollar is if we go to 1970s, roughly 77 through 99, this whole area back here. And you can see we had this peaking formation from 77, roughly right in here. The U.S. dollar had collapsed down all the way through the peak U.S. dollar in the 80s, all the way through this weakening cycle trend back up to the peak in 2000. So when we take a look at this, delete, from a cycle trend, look at what happened with gold through this depreciation phase, all the way through this peaking, and then we had this extended sideways channel in gold through a depreciation cycle phase and an expansion or appreciation cycle phase until we got to the 9/11 attacks with Fed monetary policy. Now, Fed was still creating money during this time, but this was a smoother, less conflicted area. There was not a lot of crisis and war in this time frame, and we started getting into real global conflict with the first Kuwait War, which was back in this area over here, and then we started with the 9/11 attacks back over here. So I think what we're going through, again, ladies and gentlemen, is kind of a replication of this paired with a replication of this. So if we understand that a dot-com bubble, which took place here, and the massive cycle inflation after the end of the gold standard, which was way back over here, this was a cycle phase where the U.S., we don't even have the U.S. stock market back here, but suffice it to say that the U.S. stock market was rallying fairly solidly through the 70s and the 80s. It really peaked out in 1999. So in reality, we have a pretty good rally all the way through. And look at crude oil having these peaks during this time frame here with the U.S. dollar and bottoming in oil or in gold. We have a peak in this area just a little after that formation, which is here, right here. So here's a peak in the U.S. dollar, bottom in gold. Oil tops out and collapses massively during this time frame. Oil collapsed how much, you might ask? Let's see. It went down about 80%, 60%, based on rough numbers. Then we had a similar scenario here where oil collapsed again, 63%, 60%. And that happened right here during, again, a bottom in the U.S. dollar, a sideways trend in gold, and a relatively strong appreciation trend in the 1990s in the U.S. stock market. Money was still pouring into the U.S. stock market as the cheaper dollar provided global currencies to continue to expand. This was in the 1990s. It was a pretty good time, if you remember. This was a moderately strong time. The computer companies were growing. Give you an example. We had DOS-based computers. We had gone through the 70s and the early 80s with the influx of Japanese cars. This was the time that Japan had really rallied back in this time frame and peaked. In 1985, Japan did, and it started weakening. And then we ended up going through an extended cycle phase. I think I may have drawn that inadvertently, because that doesn't correlate to anything. Let me get rid of it. We had an extended cycle phase where the dollar rallied in late 90s. And again, this is where I think we're kind of like very similar to the late 90s. So let me redraw this. To this. I think we're living through this right now over here in gold. Okay? This is what we're living through right now in gold, right here. This peaking and sideways formation, but I think it's going to happen quicker than what we saw back here. I think this bottom is going to, instead of being 5 years of a bottom near the end of the appreciation to depreciation cycle phase, I think it's going to happen much, much quicker. And why I think it's going to happen is I think we're going to have maybe 3 or 4 more months till the end of this year, possibly in October, November. So that's going to be right here, that we are going to be looking at some sort of a massive crisis event. I'll move this over to here. What this means is we're looking at a combination of the late 70s inflationary cycle trend that the Fed is going to have to battle by raising interest rates. This means interest rates are likely going to go up by more than anybody thinks. And when I start talking about Fed funds rate, I'm starting to think that a 7.5 to 9.5 Fed funds rate is going to be necessary to battle inflation, maybe higher. So that puts the 80s, the late 70s to mid 80s time frame in place. And remember, during that time frame, we had Japan rallying up. We had the growth of certain foreign markets, and then it all collapsed in the mid 80s. And what caused that collapse primarily is the Fed raising interest rates in the United States and destroying a large portion of American consumer demand. That's what ended up blowing out Japan and creating the next phase, which was in the late 90s. We had the rebirth of the internet in the US, which created a cycle phase called a speculative cycle phase, the dot-com bubble burst. Many of you remember the dot-com bubble and the bursting that took place during that time frame. We've had the same thing after COVID, a same type of speculative phase. So we've got the early 80s pairing or mingling with kind of a speculative cycle phase because of the COVID bubble and the speculative phase that came into play from that. On top of that, again, ladies and gentlemen, we have the foreign currency crisis that took place in the 80s, so kind of very similar to what happened with Japan. So remember, from the 80s right here, we had a peak US dollar, collapsing market, moderately strong US market, and gold continued to base. My opinion, though, is because we're in this phase here, this contractionary phase, this depreciatory phase, my assumption is the US dollar is going to rally a bit further, putting more extreme pressure on global currency. I'm calling this the predator US dollar. This is going to cause foreign currencies to deflate to the point that many may enter some crisis phase or bankruptcy phase, and I'm talking foreign market collapses, potentially massive collapses in foreign market while inflation is rampant, causing major issues with food and supply and potentially what I call the Great Reset. Now, this will prompt oil to potentially collapse down into the $50, possibly $40 area again, because the demand for oil will collapse when consumers aren't able to supply demand for foreign oil. The U.S. market may hold up, as I've drawn here. I'll try to draw this a little bit differently. May hold up a little bit, but eventually the U.S. market is going to find weakness because the U.S. market is unable to sustain growth. The Fed will have to raise rates. The Fed will have to battle inflation unless the Fed is willing to risk almost uncontrolled inflation, risking global security from a standpoint of global economy and humanitarian crisis and global war, which it could lead to something like that, because uncertainty creates a lot of angst, and angst leads to war. Long and short of it, we're in a combination of a few various cycles. The dollar will rally a little bit further, maybe another, because we're at 106 right now. Long and short of it, I think we're going to see the dollar up about 110, 112, maybe 113 before peaking. The U.S. market is going to flag out. The stock market may see a little bit of a rally over the next couple of weeks, but then it's going to weaken. Try to find support around the SPY, around 302 to 310, and then move sideways for a period of time until some impetus comes into play. Oil is likely going to collapse down to around 50, 55. And I want you to understand that that's to be expected at this point on a contracting economy. And gold should start to move up to the $2,200 to $2,500 area, possibly more aggressively up above 3,000. We'll see what happens. But we're at a point in time where I don't think I have ever seen anything like this. We've got 70s style inflation, 90s style super speculative bubble, 80s style commodity price appreciation. We've got 2013-14 style foreign market contagion events, which is also very similar to the 1993-94 Asian market crisis and or the 85-86 type of Japan rollover, which is really the late 80s weakening of Japan. But all of these are converging into one. They're all converging into one event right now. Right now, between now and the end of 2024, we have got a massive crisis event, which is essentially a global credit monetary crisis, a major inflationary cycle phase, very similar to the late 70s and early 80s, a peaking U.S. dollar, which I'm calling the predator dollar. Stronger the U.S. dollar is, more money will move into the U.S. market. But again, this is setting up to, almost like the perfect storm. I don't know how else to explain it. Emerging markets will become strongly under pressure because of strong U.S. dollar. Collapsing oil prices will put foreign markets under pressure that rely on oil revenues. The U.S. stock market will initially benefit from some of this, but ultimately will become a great risk because the collapsing markets will create turmoil throughout the world, and gold and silver will act as the ultimate hedge. So we've got the dot-com bubble, the foreign market peak. So think of Japan. What was Japan in the early 80s is now China. We've got runaway inflation, which is, again, late 70s, runaway inflation carrying all the way over into the mid-80s, late 80s, which prompted stagflation, which, again, is why I keep telling everyone, I think we are right here in gold. If I could do anything and say, I think we are right here in the absolute market forecast. Okay, if I were to tell you exactly where I think we are, we're right there. We're at the peak, the initial peak in the market, which took more than 15 years to recover with extreme downside risk going all the way across here. I think we're right here again with, and I can add into the scenario, with this hyperinflation phase built in. The Fed is going to have to raise rates. It's going to create a deflationary cycle trend for oil. Now remember, oil stayed back over here in a very tight, narrow channel between $10 and $30 a barrel throughout this extended cycle phase. So call it $10 and $40 a barrel. The reality is oil was extremely cheap during this time frame. And why? Because ultimately, as the weakening U.S. dollar and the stagnating economy produced a sideways cycle, gold didn't appreciate. Why didn't gold appreciate? Because we didn't have the extended risk factor of a global war taking place and global contagion event. This was a totally different world where we were not at 102% debt to GDP. Now we're at a new world. U.S. has printed extended money. Global central banks have printed extended money. We've got hyperinflation. We've got the same type of setup, speculative bubble phase. U.S. markets at a speculative bubble phase, which is why they could collapse even further back down to this support level that I drew. Oil's likely going to move back down into this $40, $50 area, potentially move into a sideways stagnation phase unless we get into a massive war, which I don't think is going to happen. I think they're going to stay regional. But gold is going to move aggressively higher. The dollar is going to peak over the next 6 to 7, maybe 8 months, maybe. And the U.S. market's going to continue to flag out sideways until we have some certainty of a bottom. And that means that ultimately we could see the COVID lows retested or these 2015 lows retested around the 180, call it 184, 185 level. That's why this predator dollar setup is so interesting. We've never seen anything like this that I can remember. 80s, 70s setup, mid 80s setup, late 90s setup, the dot-com bubble burst, and now we have the emerging markets and foreign market currency crisis setup, which I equate to the end of the 2014-15 cycle when refocused back on the U.S. market and the strength of the U.S. dollar, which is right here. This is when the emerging markets, they went through a period after the crisis here in the stock market. Emerging markets became very, very hot. 2011, 9, 10, 11, 12, 13, 14, they were very, very hot. Then all of a sudden around 13, 14, everything ended. The U.S. dollar started strengthening in an appreciation phase right here, middle of an appreciation phase. Oil collapsed, dollar appreciated, U.S. markets went sideways flat, and gold bottomed. Gold took about 4 or 5 months and bottomed. Actually a little longer, maybe about a year. So what we have here is emerging market crisis, foreign market crisis, dollar strengthening again. This is very similar to right here. And we could see this continue to move higher. As the foreign markets collapse, the dollar could strengthen. Gold could become a huge safe haven asset. U.S. markets could continue to move into a sideways consolidated trend. And oil will likely move down to $40 or $50. This is what I'm calling the predator U.S. dollar cycle. There's never been anything like it. I don't know how to explain it clearly. Just get ready for some unprecedented events over the next 5 years or longer. That's it for now. Follow me on Twitter. Follow me on YouTube. It's going to be extremely exciting, as I mentioned to you here, and tried to draw gold based on my technical research has the potential of moving above 10,000 before 2028-29. So I actually drew it a little off. If I can draw this better for you, 2027, right about here, 10 grand. So this is kind of where, well, that didn't work. Let's try it one more time. 2027, roughly there. Kind of like that. Maybe a bit more aggressive. Maybe more like this. But long and short of it, gold is likely to become a very strong safe haven. And I want you guys to be aware that this move in the dollar is not over. The move in the markets is not over. It's going to consolidate and flag sideways. Oil has peaked, in my opinion. This is a move that the economies are contracting. What this is doing is basically saying that consumers are pulling away. The pressure of the predator U.S. dollar is contracting the global markets. Similar type of thing happened back over here, but this was a late contractionary phase. Same thing happened over here. The strength of the U.S. dollar weakened oil at the end of an expansion phase. Now understand, we're at the end of an expansion phase here. This is end of an appreciation cycle phase. And what happened? COVID hit. What happened when COVID hit? Global central banks went into overprinting of everything. So this area here, from here to here, there to there basically, is an excessive bubble of central bank creation. And that's why we have something that we have never, ever, ever seen before, other than way back over here when we went from zero, oh man, zero credit expansion back here in the 70s. I don't know if we're going to have anything back here. Yeah, we do a little bit. We have US dollar. So this was the creation of the Fed. The dollar moved throughout this area, and we may have something here. Yeah, we do. So here's the creation of the Fed. We move off the gold standard, and look what happens to gold. Gold moves from these lows at about $100 an ounce up to approximately, what was it, $700, $800 an ounce. So it's an 800%, 700% move in gold while the dollar collapses through this cycle phase. And this is what ends up happening here. We've created this massive credit expansion phase. And this actually took place in our past. We don't have data going back here for oil or anything else. But then we end up in this massive US dollar recovery phase. Gold sets up a new base, rolls forward. And as I mentioned to you, we're looking at being right here, right now. We're going to look at the dollar rolling over in 6 or 7 months. The U.S. markets collapsing even further, possibly down another 40, 50%, depending on what happens. Oil collapsing possibly another 30 or 40% lower. And gold setting up a massive base that could extend for as many as 6 or 7 years, possibly longer out in the future. Follow me again on YouTube. I'm going to help you navigate how to profit from these big trends. But the predator US dollar is coming, and it's going to destroy many, many opportunities for those who are not prepared.